Hi, this is Alan Gassman. I'm here with my friend and colleague, Paul Hood. Paul has a much nicer background than I do, that's for sure. Look how beautiful that palm tree is. We're here today to talk about running the numbers on self-canceling installment notes and private annuities. And I know that a lot of you have a lot of knowledge on self-canceling installment notes and private annuities, but maybe you haven't run the numbers the way we're going to run the numbers today, or maybe you haven't had that capability. So it really takes some experience with the numbers to make decisions in this area and sharing those numbers with the clients. So Paul, do you want to give a little bit of background on what a SCIN is and what a private annuity is before we forge into illustrations?
Sure. I think what I'll start with is just a SCIN, a self-canceling installment note, or what I often refer to preferably as a death terminating installment note. Because it's not self-canceling at all, it's death that terminates it. It's just a variation of an installment note, but it has a big proviso. And the big proviso is if the maker dies before the note is repaid, the note is canceled. And you say, okay, well, wait a minute. If somebody who was in very poor health entered into a long-term installment note, they know they'd never get paid back. Is this better than that? Well, it could be if you have the proper evidence on the note. So how do you determine how much you need to charge to justify a self-canceling feature? And there are two ways to do that. One is an enhancement to the price or value of the property being contributed. And the other way is an interest rate enhancement. And interest has always been used to gauge risk. I personally believe that interest is the only way you can do this. It has to be actuarially determined. In other words, they have to charge an amount in addition to the applicable federal rate that someone willing to take such a risk would get in a fair market value determination. But the benefit is if you die before that note is paid off, your heirs are benefited by that. There's no inclusion. The note is worth zero. Which can be bad if that was actually the inheritance that some of the other side of the family was expecting. So you have to be real careful with that. A private annuity, on the other hand, is similar in that it's just a contract, and you can do a private annuity in a page or two. A client exchanges an asset for an unsecured promise to pay for life, and the payments are set when the private annuity is created. I mean, they're almost always immediate annuities, but they can be deferred, but that has to be factored into the calculation. And again, it's a 75-20 calculation, but the private annuity I've had used it on a couple of situations to great delight from everybody involved. So let's get into it. Let's get into it, Alan.
Okay, I'm just going to mention with a private annuity, you can use the standard expectancy table as long as there's not a physical condition expected to bring your client down within a year. So somebody in poor health with a 2-year life expectancy can use a private annuity. With a self-canceling installment note, it's not so clear, and the service takes the position that you're making a gift if you use the standard tables and the person is of less than normal health. The second thing I'll mention is that either a sale for a canceling installment note or an annuity would have income tax implications if you sell to your children or you sell to your grandchildren. So usually the sales are to a grantor trust. so that you don't have the income tax issue on the sale, and so that the grantor can pay the income tax on the assets under the trust.
Yeah, I don't think they're eligible for installment treatment either. So that's another bad thing.
The other aspect, though, is if you do a private annuity, there's something called the exhaustion test. And if you're not exhausted already, we'll cover that later. So I'm going to open up the Estate View software here. And to get to the Estate View software, if you want to actually play with it while we're doing this presentation, you can put the word estateview.link, estateview.link in your browser, not in your search box, but in your browser. And then just click the blue button and it will turn on for you. And then you'll see the view that I'm looking at here. And if you are watching this and you're not an Estate View subscriber, you get a free month of Estate View so that you can try it out and do what we are doing here. And under the Estate View, you see a single client comprehensive plan, a married client comprehensive plan. These both have installment sale calculators, but then we also have under the calculator section a very fact-specific self-canceling installment note and conventional installment sale calculator. We have Jerry Hesch's installment sale with income tax analysis, and we have a private annuity button. So I'm going to start with the self-canceling installment note. When I click the self-canceling installment note, I am in standard mode. This is what Jerry asked us to do to keep it simple at first. And standard mode generally does what the other calculators that you may be using do. It knows the 75/20 rate, and it knows the applicable federal rate. So this calculator will tell you what the lowest applicable federal rate is for the 3 months you can use, this month and the previous 2 months. It knows the 75/20 rate to use, and then it allows me to do a self-canceling installment note for either one person or two people, because sometimes you do it for a married couple.
Alan, stop.
I think on the 75/20 you can use the best for charitable, but for the AFR part of it, you can use the lowest of the three for an installment sale. Paul just took his jacket off and we arm wrestled and I won. So we're going to use the lowest of the three applicable federal rates. Now, when you're using Estate View, if you want to see the history of the applicable federal rate, you just click on this blue button here, applicable federal rate, and then it will show you the history and what it is now. So another thing you want to do, and this points it out, is you don't want to use your last birthday. You want to use your nearest birthday. So you want to put in the client's birthday, and then it will tell you their nearest birthday, which you could be age 70, but if you just turned age 70, that's your nearest birthday. If you're late in age 70, then your nearest birthday is age 71. Then Estate View tells you your life expectancy, which is just nice to know because there's a rule of thumb in our industry and maybe a fable, and that is that you should not have the note that's going to be self-canceling extend beyond the table 2010 life expectancy. Jerry Hesch says that's wrong. If you go beyond the life expectancy, Jerry says that's fine, as long as you put that into the calculations, which Estate View does at Jerry's request. But to play it safe, for this 70-year-old, we can do a 15-year note. That is within the life expectancy. And then it asks you, what premium are you using, interest or principal? The only time I've ever used principal premium, Paul, is when the client gets really old and the interest rate would violate the usury rules. Then I've used a little bit of principal markup. And then the payment type, which you almost always want to use interest only because that's going to give you a better result. But you could have it amortized if you choose. And then we always have a simulated sale in Estate View. So the question is, how much is your sale going to be? How much is your note going to be for? Now, again, as I told you, this is our simple version known as standard. And now I can click to see my results. Now, when I click to see my results, I have my inputs on the left-hand side that you just saw. They're just arranged a little bit differently. And I have them summarized in blue across the top in what we call sale note summaries. You see that the exact same information. And then in green, I have my results. So I didn't do a principal risk premium. I did an interest risk premium. So my interest rate between the applicable federal rate of 4.14% and the note premium comes out to 8.49%. So my annual payments are going to be $84,900 a year for 15 years. Now, if I want to try and see what else I could do, I can click the green duplicate button here. And one thing I might do is see what the situation would be for a husband and wife or a married couple. So I'll go from 1 to 2, and I'll say that second spouse is 65. So, and I can just toggle up and down. So 1 is just a 1 life, 15-year age 70. The other 2 life, ages 70 and 65. Now my premium interest rate is much lower, and my interest rate is much lower. You know, it's really not that different, Paul, between a 4.14 interest rate and a 5.6951 to hit a big premium, a nice result for a family. Maybe they fly a lot and they're concerned about the flight. Maybe before the flight, we make the note self-canceling at a slightly higher rate. And then when they get back from the flight, after they learn to parachute and they've jumped a few times and are done, or they stop diving with sharks, then we can move the rate down.
Right. You know,
So
go spelunking.
right. Now, SCIN number 3 would be, what if we went to 20 years, which Jerry says we can do. The other calculators don't do this, by the way, but we can go 20 years. Now here it says, warning, the IRS may treat a SCIN exceeding life expectancy like a life annuity. They might, because there's confusion, but we don't think they really can in this situation. So now I'm showing you a 23-year note, and the interest rate would have to be a lot higher because there's a greater risk here for the seller. So that's the simple mode on the self-canceling installment note. Click on the pro mode now. And by the way, Estate View has 3 different pricing models. Standard is $199 a year, and it does generally what the other programs do. Pro is $399 a year, it does a lot more, and Pro Plus is $499 a year and does a heck of a lot more. So when I click on Pro, the situation now has changed. I still have my inputs that I showed you in blue at the top. I've got more information in off-white, and I still have my results in green. But there's more things I can do here. For one thing is I can put in an exact transfer date. So I could change the date to an exact transfer date. And also, now I can set the client's actual year of death to show whether they made the 15 years or not. I can set the second spouse's actual year of death. I can pick my mortality table, which is always going to be 2010 and for now. And also, I can run with the note being non-self-canceling if I want to. and I can specify my estate tax rate. We do not have state estate taxes, but you could ramp up the estate tax rate if you're in a state in order to at least estimate what the situation would be. And I have my asset growth rate as well. So for example, SCIN number 3, I could go ahead and change my years illustrated to 25, and that's going to change the estate tax saving result. I'll go back to 30 just to get it back to where it was. Now, in addition, in the pro mode, I'm going to have a year 1 gift, a seed capital gift, as they call it. And everyone says you don't need it to be 10%, but we typically show it at 10% because of the misconception that you should. So probably everybody does, and that's probably the safest thing to do. And then
doing homage to the late great Burl Abbott.
Right. But you could have it be lower, but if it is lower, it's going to warn you with that little red warning. And then I'm going to have $1 million self-canceling installment note. I'm going to show that the grantor pays the income taxes on the trust income. I'm going to show that the taxes are a certain percentage of the value of the trust assets. I'm going to show the grantor's income tax rate. And what I'm not going to show yet is what the Pro Plus mode does, which is contributing discounted assets and putting in an asset that not only grows by a percentage of value, but also has a dollar amount growth. So now, for example, GRAT number 4, installment sale number 4. Across the top, I have all this information, and I could have more or less information above the top. Right now, I have plenty of information, but I could have less. I don't need to have as much as I have if I want to make it a little simpler across the top. And then below, I have a spreadsheet. So for each one of these installment sales, installment sale 1, 2, 3, and 4, I have a spreadsheet which shows the amount in there, the amount of the growth, the amount of the payment, the estate tax savings from the trust assets that are growing, and the estate tax savings from the burn. So based upon any year that the client dies, there's still going to be estate tax, even though there's a premium interest rate being paid back to the grantor. But after the grantor dies, there's going to be a greater amount of savings. So that takes me to note number 4, with estate tax savings of $1,838,000. I'll fit with there. Now I can go to Pro Plus, and with Pro Plus, I'll go ahead and set up sale number 5. And with sale number 5, I can go ahead and now put in a discounted asset. So right now I've got $1 million value before discounts. Let's say that I take a 35% discount on the assets I put in, or let's just say a 30% discount. So now my value before discounts is the same in 4 and 5, but my value after discounts is different. So my payments are lower, and my estate tax savings much higher. Now $2,611,000. So certainly it makes sense to take that discount. So that is sale number 5. But now I'll go to sale number 6. And this is something that the other programs don't do that I really wanted to do. And that is, what if this is S corporation stock? It's worth $1 million. I'm giving 99% at a $700,000 value. It's growing at 7.5% a year, but it also pays a dividend. And that dividend happens to be $100,000 a year. Well, now I can show that in my spreadsheet and look at the savings now. It went from 2.6 million to 6 million. So that's the phenomenal impact of a self-canceling installment note, second to die, so that the interest rate is relatively low, longer than life expectancy, using a valuation discount, and using a income stream that takes it out of the client's income stream. So Paul, any comments or suggestions on that?
No, I think, first of all, the difference between this last most advanced mode and the basic, I mean, is stark. And you know, I mean, I think that is a great aspect of it. I think you're bringing along the Monte Carlo that we'll discuss one day, is going to add to this. But the presentation and explanation and PowerPoint aspects of this are, I think, what definitely set Estate View separate and apart from every other program I've seen.
Yeah, thank you very much. It's just important. Some people say it's complicated. Well, an installment sale of a self-canceling installment note is complicated.
Yes, it is.
So we've just tried to give the user a checklist of every piece of important information they would probably need, and an ability to show it in the spreadsheet. Now, just as I showed you above there that you can alter the summary columns on the summary above, you can also do that on the spreadsheet. So we're looking at sale number 6 here. I can alter my detail columns. I can show the probability of survival through each year. I can show the beginning value each year, probability of death each year. So you can have a robust spreadsheet. And I'm going to show you other spreadsheets, but this is one of the spreadsheets that you can do for an installment sale. You can pull it up. You can show every second year, every third year, every fourth year, depending if you want to try to simplify it. And then you can click on Export to Excel and go up to the arrow there in your Chrome and click on it. And it opens, so you have an Excel spreadsheet, and then you can go ahead and put their personal budget in, because that's what's really important. Will they run out of money? And if they run out of money, when would that be? Other features of the software that I just want to mention and show you is I can generate an explanation. So I go up to generate explanation. Let's say I want to generate an explanation of SCIN number 1 and SCIN number 4. Click on PowerPoint presentation. Say it's Paul Hood. Spell his name right. Click on submit. So there's 2 PowerPoints now. I open the PowerPoint. There it is. It's editable. I can't eat it, but I can edit it. And so the PowerPoint shows me I made a seed capital gift of 100,000, payments over 23 years to age 85, 2.5981% interest rate premium, no principal risk premium.
Which I think is the safer way to go.
Yeah, I agree. Then the value of the assets sold $1 million, beginning value of the note $1 million. And then there's your spreadsheet and an explanation of your savings. So we'll be improving this as we go along. But let me go back now to the software.
Well, and I just wanted to say that, you know, as I've been working on the explanations and the PowerPoints for all the calculators, it's just it really is integrated how your uh, fact screens, it's not the right word, your inputs end up in the PowerPoint. It's just, you know, today it it's a hell of a lot easier to get a client to do something that you have a picture that you can explain it to them with than trying to explain it in words or in print, because most clients don't have the facility to get it, or at least to get enough comfort to do whatever it is you want them to do. But here, I think that's one of the biggest benefits of Estate View is the explanatory ability of the calculators and the plans, um, and not only with long and general and short explanations, but PowerPoints that can be transferred to clients. And when you add the y'all can play with it for 2 weeks feature, I mean, there's a whole lot to like about Estate View.
Yeah. So thank you. So also just some other things, timelines and charts where you can show what the assets look like, the payments and etc. Probability of survival of death, comparing an single individual to a married couple. This is the trust value over time for each of these scenarios. So there's a lot to look at. There's plenty to play with. Now, if I want to save what I've done here, I can just hit File, Save As, All one, click Save. Now it's saved to my computer. And then I could click File New and just start all over again. But if I want to go back to what I had, I can go to File, Open, and find what I had. Now, if I want to share what I have, I can go to Share with Client, click URL, copy to clipboard, and then I can just go to an email, paste this into the email. Hi, Paul, you have 14 days to use this software module with the settings in it. And then he copies and he just pastes, he clicks on that, inputs the 537372 code, and he has 2 weeks to use it. So I can collaborate with my fellow planners. So that's that particular module. I think now we should go to the private annuity.
Yes.
Before we do, I just want to mention, because we probably won't get back to it, that Jerry's favorite section is right here. I went back to home and I went to installment sale with income tax analysis. When you click on that, you do have to put the data back in again, but it will specifically tell you it will build the spreadsheet for you, both as to the grantor and the grantor's estate and the impact of the burn, and as to the irrevocable trust. As I said, this is Jerry Hesch's favorite calculator. It does allow you to put together the spreadsheet. You can toggle off grantor trust status. You can make the note canceling, non-self-canceling, go to our SCIN calculator to determine the rate you're going to use, and you can just click on, where do you click? Oh, the rate
you don't know, we're lost.
Click on Save Results to Excel in order to save it as an Excel spreadsheet. Okay, now let's go to the private annuity. Now the private annuity, I'll start on standard mode. It's telling me the 75/20 rate, which is the rate you have to use. I can do a 1-life private annuity or a 2-life private annuity. Client age is going to, of course, have a big impact. You want to use the age at the nearest birthday. And then it also allows me, Paul, to do a deferral period. Now, in the Kite case, for example, Mrs. Kite didn't start an annuity where she got paid right away. She was going to wait a number of years before her first payment, and her payments were going to be larger. So I could also have payment terms that are either level, which is what most of the calculators do, or graduated. So my first situation here, and I'll click on see results, is a 70-year-old putting $1 million in, no deferral, interest rate 4.8%, annual annuity $99,614 for life. Then I'll go ahead and do a second one. Annuity number 2, I will put joint and survivor for 2 folks. One's age 70, one's age 75, and call that number 2. You see a lower payout rate there. Then I'll do a third one. The third one, I will defer the first payment to year 4. So the first payment will be in year 5. Now the client dies in year 3. There's no payment ever received, but the annual payment amount will be $131,000 a year. And then annuity number 4, I'll wait 4 years, but I'll use a graduated payment, and I'll have the payment increase by 3% a year. So now it's going to keep up, hopefully with inflation, maybe go 4%. That first year payment's going to be at $85,000 a year, but it's going to go up gradually. So this is what most of the calculators do. Paul, any questions on this?
No. Obviously a joint and survivor annuity for a couple is usually a more palatable sale than a one ski.
Well, it depends on if you're trying to reduce the estate or if
Right. It depends on what you're doing. Right.
they actually need this. Okay, so now I'll go that up there. It's a little bit sticky. All right, so now I'll go to pro mode. And I think what I'll do is I'll delete the first 3 or the second 3. So now in pro mode, oops. I'm looking for my PowerPoint. Okay. Okay, so now I'm going to go to pro mode. And now I have more information on the left, but let's see how this compares to the standard mode. I've got a 1 grantor age 70. Now it's showing me his life expectancy is 15 years. I can pick a date of death, such as year 15. Number of years illustrated, I can go 30 years. Year 1 gift, which we'll add in. Right now it's at 0, so we would assume that he's transferring this annuity, these assets, to an established trust. And then the trust needs to have a value of $1,741,000 before the transfer in order to satisfy the exhaustion test. And Paul, do you want to comment a little bit on the exhaustion test?
Well, no, not a lot, because of its complexity and some of its own there's not full agreement. I remember Ed Benjamin fighting about 77-374. He was ready to go to court with him over it. But the bottom line is that those computations are very, very I take them with a grain of salt. So
okay. So now the PowerPoint Oh, and by the way, the other calculators do give you the exhaustion test. And one of the best write-ups on the exhaustion test that I've seen is by Larry Katzenstein, who has Tiger Tables, which is just a wonderful software.
And
So
Larry's a wonderful teacher, thinker, and lawyer and gentleman. I've worked with him a couple times. He's a great guy
yeah,
and smart, smart, smart.
absolutely. I'm really thanking him for all the pioneer he's done. Across the top, I can also put in more information or less information, depending upon uh, what I want to see. And then again, I have the PowerPoint, which shows me what the situation is if the person doesn't die. And do I come out ahead or behind based upon whatever year they die? My other inputs here, as you can see from the vertical lines, are besides the year of death, the number of years illustrated. If I wanted to look at an old annuity sale, I could look at one of the older mortality tables, the estate tax rate, the asset growth rate, and now the year one gift, which might be $100,000. For example, if I want to make a gift in addition to the annuity, or maybe this needs to be $1.7 million. Now, what I'm not showing yet is the ability to fund the private annuity sale with discounted assets and the ability to fund the private annuity sale with an asset that not only grows, say, at 7.5% a year, but also throws off some income. So I'm going to go back and do private annuity number 2. And private annuity number 2, maybe I will have a year one gift of $1.8 million so that I satisfy the exhaustion test. And also I'll go to Pro Plus here, come back down, and where was that? See what happened there. Said
What you looking for?
contributing discounted assets. Oh, there's my discount rate. Okay. Okay, so I'm going to now take it to Pro Plus, come down here, and I'm going to have a discount on my $1 million of assets sold of, let's say, 30%. So it's $1 million worth of assets being sold for $700,000. You see that there. Now you see a smaller annuity and you see higher estate tax savings. And then let's say that this is an asset that pays set $100,000 a year of income in dividends, growing with inflation. Well, now you see even a much larger estate tax savings. The other calculators and most of your spreadsheets, Paul, that I see don't take into account the dividend income or the partnership income. They just want to put in a growth rate, which
Right.
doesn't take that into account. And then, of course, we're going to show the grantor is going to pay the income tax. And then in the spreadsheet, true to the Jerry Hesh model, I'm showing the estate tax savings from the annuity itself and also the estate tax savings from the burn, so that the total estate tax savings is the combination of the two of them. Then I can show my timelines and charts. So this is what the annuity arrangement looks like, and comparing the two arrangements there. So as with the installment sale, once I have what I want to show the client, I click on generate explanation, click on the 2 private annuities, click on the PowerPoint presentation, put the client's name down in there, Click on submit. And now I have the PowerPoints. I will share my spread screen so that I can share this with you. Stop share.
It's really such a neat feature. It's really such a neat feature of estate view, by the way.
Thank you. Where are we? It is there. So then here's my estate planning with private annuity PowerPoint. As you can see, it tells the client about the advantages of a private annuity. It's $1 million in the LLC, a $700,000 sale, some warnings about things that could go wrong, and the 50% chance of survival rule, current age 70, normal life expectancy 86, asset transfer value 700,000, growth rate 7.5%, 75/20 rate 4.8%, annual payment 69,730, exhaustion test assets, and then just more information and the spreadsheet. So certainly something deliverable. And then we have discussion of the kite case. So that
these days the kite case will get corrected.
the kite case will get corrected. What's wrong with the kite case?
Well, the whole the Q-tip 2519, they kind of got, it was kind of heads they win, tails, you know, we lose. And there's a problem in there. I've read about it and I've written about it. Don't remember all the technical explanatory details, but suffice it to say that it's far from clear what that kite, you know, wasn't wrong, and I think on that aspect it was most definitely. And I know some people share. I think Ockett felt that way. I think Zaritsky did, and somebody else, I forget now.
Well, certainly example of how you could use a deferred annuity. So I think that part.
Well, yeah. Well, no. It had good planning. I think the tax court was somehow worried about the interplay between 2519 and Q-tip, and kind of overreached there. And I wish they would have pursued that on appeal. But you know, they figured out a way to settle the case. And of course, if you can settle, you should settle. Who cares what Hood wants you to go for? If you can get at it with a quantifiable, you know, cost, go to it. Especially which beats the hell out of going to the next level of a court. You know, just add a couple of zeros to your legal bill, and that's where you're headed. So anyway.
Okay, so I'm going to go now to the married couple segment. And this is what we call a comprehensive married couple plan. And we have the inputs on the left, which you can expand by clicking there. And we have a lot of different techniques you can use, including the installment sale. So obviously you put the client's name, you put the date of birth, you put their age, you put how much they're saving right now through a certain age, and then how much they'll save after that age. If you want to go to a single person, you can, and show a credit shelter trust and a portability allowance. And then let's say that their business and investments are 25,500,000, growing at 6.5%. They're paying 0.4% in investment costs, 2% of the value in income taxes. But that includes an exploding asset. And they tell you that exploding asset is worth $4,750,000 today, but they fully expect that in 5 years it'll be worth $12 million. They expect to pay an income tax of $3,250,000 on the sale, and they're willing to sell part of that in an installment sale. And then they've got a $3 million home. They're going to do some Cuperts. They're going to do gifting. They're going to have life insurance. I'm going to skip all that. But here's where there's an installment sale. So the installment sale can be spouse one or spouse two. I don't have both spouses doing separate installment sales yet. And for the purpose of this discussion, we could start off with they will put $19 million worth of the assets into an LLC or LLCs. They will take a 30% discount. So the installment sale will be for $13,300,000. And their year one gift will be $1,425,000. And if I want to change any number, they all change. So if I just click up on the amount going in, the net amounts of sale, and the year one gift changes. And then they want to put the explosive asset in. And as far as the explosive asset, they'll sell 30% of the explosive asset. And with the explosive asset, they'll also use a 30% discount. So their total sales stays at $14,720,000. They'll do a conventional note at 5%. They could do a SCIN. That would work fine. In fact, we could let them do a SCIN. And then the interest rate on the SCIN, we already calculated it, but let's say that it's going to be 7.25%. We'll assume that they will not toggle off grantor trust status, and that the installment sale trust will receive not only the growth of the asset, but another $200,000 a year. And if they die with the note, if it's conventional, in fact, I'll make the note conventional for now at 5%. So if they die with the note, it'll be discounted at, let's say, 15%, because it'll be a long-term applicable federal rate note. And you can even put in a guarantee. Maybe there's a guarantee fee if you don't have a 10% seed capital gift and you want to put in a guarantee fee. It can be a percentage of the note. It could be paid over 6 years to a gift trust. So I click back. And now, if this couple does no planning and the surviving spouse lives to year 20, you're looking at a $27 million estate tax. If they do a credit shelter trust, you're looking at a $24 million estate tax. If they do Cuperts, in this scenario, one Cupert, $23 million estate tax, annual gifting, $21 million, discounted gifting, $20 million, life insurance trust, still at $20 million. How about a large gift? Now we're at $19 million. So now from a $19 million estate tax in 20 years, I click on that installment sale. When I click on that installment sale, the estate tax comes down from 19 million to $6,800,000. And I can picture it another way as well. I can click on timeline. And when I click on timeline, I see that before the installment sale, this red area is the estate tax that comes out of their estate based upon the year of death of the surviving spouse. And it'll change a little if I change the year of death of the first dying spouse, but not a lot. That's the credit shelter trust there. When I click on installment sale, that estate tax comes down considerably. So that installment sale is very valuable. But I can do a little bit more there And, I was only giving 30% of that explosive asset. What if I go to 40%? Well, you see that tax come down as I scroll up the installment sale. The value of the result here gets better and better. But there's only so much they can do an installment sale for. But this is just another way to show the client the use of a private annuity, which can have the same freeze arrangement or a installment sale. And of course, if I change this to a SCIN and they die within the SCIN term, then the red is going to be gone. And then alternatively, I can go to testamentary charity, click on testamentary charity, and now they don't have any estate tax, but the family gets even less. When you click on installment sale, the red is the estate tax. But if you want to zero out estate tax with charity or with a CLAT, I'll click on CLAT there, then a lot more has to go to charity. There's still less estate tax. If I put 100% to the CLAT, then that's where you go. So, because some clients say, I don't need an installment sale. I'll just go directly to charity. Well, if you go, directly to charity without the installment sale, it's a much less for the children. I'll click off installment sale there. That's how much has to go to charity to zero out estate tax without the installment sale. And that's how much with the installment sale. So now I'll go back to the logistics and just show you now, if you want to share this with the client, including the installment sale results, which are here, which tell me the initial net value in the installment sale. Immediately after the installment sale, I've moved 9.8 million out of their estate just using that discount. Then by the second death, that installment sale trust has almost $40 million in it. Anyway, I go and I click on generate client letter. I can select whatever scenarios I want to show them. And then I click on the bottom, generate client letter. And now this is going to take about a minute. So it is actually writing a letter at this point. You see that across the bottom in blue. If you have your volume up, the computer will talk to you a little bit while it's drafting the letter, giving you a brief summary of the letter. And now I'm going to have to stop sharing for a second, and I'm opening the letter for you. I'm enabling editing for the letter. Now I'm going to share my screen again. There it is. Okay, so this comes out as a Word document, and it explains the estate tax system to the clients. It summarizes their inputs, which are also stored on my computer. If they see anything they want to change, we can certainly change it any way they like. And then it reminds them that if they do no planning, they'll have a $27 million estate tax, which looks like that. And then with a credit shelter trust, with gifting, et cetera, et cetera. And then it does explain for you and the client and the other advisors what the installment sale is like. So the installment sale calculator is shown here. So it certainly shows the client the value of the installment sale. Now, for smaller estates, the installment sale, maybe with a second to die SCIN, is all they need. Sometimes they'll do the installment sale, but they're concerned about cash flow. So we do a SCIN to the extent needed to give them the cash flow they want. For example, if a full SCIN would give them $800,000 a year, and a conventional note would give them $400,000 a year, and they need $600,000 a year, then we'll do half SCIN and half conventional note. Paul, anything you'd like to add at this point?
No, I think that I'm just amazed at how good the PowerPoints and the client presentation abilities of Estate View are. It's just it really makes for a practitioner, it makes the job a lot easier to be able to not only give people good calculations, which they need, but present it in a way that they can actually see it and understand it and buy in on it, which means they're more likely to follow it and to do it correctly. So it's a good job.
Thank you very much. No matter how good it gets, I still want it to be better. So
That's what we're working on.
yeah, we're working on it. So I welcome any questions, comments, or suggestions that anyone may have. My email address is agassman@gassmanpa.com. Paul, what is your email address?
Paul@paulhoodservices.com.
Paul@paulhoodservices.com. Please send me any easy questions. Please send Paul all the hard questions. And we appreciate so much the ability to present for Lineberg Information Services. In memory of Steve Lineberg, a great, great, wonderful mentor. So if there is any way that we can improve the presentation or that I can improve the software, please just let me know. Paul, any final words?
No, thanks, Alan. It was a pleasure as always.
Excellent. Have a great day.